at the personal level. So those LLCs are only taxed once at that individual level. So this means that a member of an LLC can pay their taxes on their business income on their personal tax return, in the same way a sole proprietorship that we already talked about would file their taxes. So this treatment is referred to as a pass-through tax treatment.
Okay, another advantage of having and owning an LLC like I do, TaxNet LLC, is you have unlimited numbers of members, i.e. you have potential shareholders in your LLC, which make it easier to raise capital and expand your business. So if you have multiple members in your LLC, you have to determine the ownership percentage for each member. In mine, I have 3 people. Some are 60% because I'm the owner, and some are 30%, and some are 20%, and some are 10%. So you have to decide when you're starting your business how you're going to share up your dividends when you start your business. And my split is 60, 30, 10 because I'm the boss.
So then the other thing to keep in mind is that with a multiple member LLC, you can choose if you want to be taxed as a partnership or as a C corporation. So if you choose to be taxed as a partnership,
what you talking about, Sherman? Go ahead.
Then you'll report your share of the business income on your personal income tax returns. Whereas if you choose to be taxed as a C corp, then you'll be subject to the double taxation that we already talked about.
And like we said, no one wants to be double taxed. So single member LLC, on the other hand, are automatically taxed as a sole proprietorship. That's what you want when you set up your business.
So another thing that you want to keep in mind is that the upfront cost that you may have to pay to maintain your LLC with your particular state. So it's very important that you understand what are the requirements in your individual state. So for instance, to operate in California as a small business owner, you're going to pay $800 in state taxes annually. So regardless of how much money that LLC makes, you're going to have to pay that out. So again, find out what are the requirements in your particular state for your LLC.
Good. And when you're starting your LLC, make sure you figure out what your state does, because I'm doing someone in another state and it's a very, very taxing. You have to find out the laws. Somebody say I could set up your business, but every business structure is different, so it takes different things to set it up. So if you're in a state where you have to pay annual taxes to operate as an LLC, then your job is to grow your business enough to offset that cost. Every state has different annual taxes to operate as an LLC, and some may not have any annual state taxes, like New Jersey. So it's important to check before you establish your business what the tax rules and laws are. Like I said, get an attorney.
So your tax advantages, the pass-through profits, and the management flexibilities still make that LLC a very popular choice. But the important thing to remember, if you don't remember anything else about what we say today, is do your homework. Make sure you do your research to figure out what's going to work best for you and your business to get the most and to get exactly what you want to get out of your business.
Okay. So let's talk about some of the advantages. How can
you use your tax deductions to lower your tax bill?
Oh wow, everybody wants to do that. So new small business owners have to stretch their financial resources, and they know that. So small business have business expenses that include vehicle expenses, wages, business travel, contract labor, hiring freelancers, and independent contractors. As small business owner, you have to pay for supplies, equipment, depreciation of assets, rent on business property, utilities, insurance, property, business, and health insurance, and repairs.
You exhausted me.
I know. There's a lot of things you have to do as a small business. There's a lot. And setting up your structure is very important. And keeping all your receipts is very important, because all of these things are tax deductible when you have a small business.
But here's the good news, everybody.
Yes,
as a small business owner, you're able to minimize your business taxes because you can write off a lot of those operational expenses that Shannon just named off when we come to tax season. inside of the tax code, it highlights what can be written off as a business expense. So again, do your homework, do your research, reach out to us. We can help you to understand exactly what can be written off, so that again you don't be exhausted like I just was with that list that Shannon just gave us.
Yes. So as a business owner, there's some softwares that I recommend. I told one of my business partners, please put your receipt in a Ziploc bag. But if you don't have a Ziploc bag, QuickBook Self-Employed Tax Bundle will automatically track your business expenses to minimize your federal tax burden, which allow you to easily claim your deduction. So QuickBook is a good software that you can use to keep your expenses organized.
So, can I write off my startup costs? The answer is a big fat yes.
Yes, we can write it off. Many brand new startups make the mistake of thinking initial business expenses aren't deductible until their business are fully operational. However, the IRS allows small business owners to deduct a wide array of startup expenses before beginning business operation. So if you had your idea a year ago, it doesn't have to be in the current tax year, and you are spending all of these expenses, when it comes to time to pay your taxes or do your business taxes, then you can claim it.
So you all ready for the number? So the IRS will allow you to deduct up to $5,000 in those business startup costs, as well as up to $5,000 in organizational costs. But here's the key, that's only if your total startup costs are $50,000 or less. Again, $50,000 or less is what the threshold that you have to meet. So with the help of a tax expert, you can write off typical costs associated with setting up a business during your tax filing.
Yes, because I will be writing up a lot of deductions for my setup. So, typical costs to set up a business includes business insurance, office space, real estate, office supplies, business cards, business assets, professional fees, hiring accountant, and small business loan fees. So if you're operating your business from a home office, you can qualify for a home office deduction. So I try to keep both offices so I can get the tax credit.
So other costs that could be included are your employee training fees, locating suppliers, and advertising to potential clients as well. So while most companies can't deduct the licensing or the incorporation fees that you may pay as a startup expense, there could be a time that those items can be deductible as a part of your organizational expenses.
Yep, it is important to remember that